But what is the better investment now? It's time for a good old-fashioned bullfight between stocks and bonds. On one side, we have equities largely outperforming this year, with the S&P up more than 6% and the Nasdaq 16% higher. Best quarterly performance for that one in over 2 years. On the other side, yields have come down from their highs and are lower than where they started the year, but are still sitting at levels not seen in quite some time, with a 6-month T-bill paying nearly 5%, down from where it was, but a nice return nonetheless. So where should you put your money now? Here on the equities bull side is Mike Binger, Gradient Investment President, and on the fixed income bull side, Maria Schrin, Circle Wealth Management Managing Partner. Maria, let me begin with you and clarify something here, because I don't want to suggest that by calling you the bull for bonds, that means you are a bear on equities and think people should be selling equities and moving into bonds. Have I got that right?
Absolutely. I do not think that being a bond bull means being a bear for equities. I think this is one of those periods where we can go back to the old-fashioned asset allocation and have both asset classes, because both have merits at this point.
But what you do say is if you have incremental money to put to work right now, given where yields are on bonds and a particular point in the maturity spectrum, we'll get to that in a minute, where bonds are now and where stocks are now, that the incremental return you would earn from stocks may not be worth the increment to risk versus bonds. Have I got that right?
Absolutely. All we have to look is, after the rally that we've had this year, where valuations and the equity risk premium are. Stocks, whether it's large cap, are trading above their 30-year historical average PEs of 16 times. We're right now at 18 times. Small caps are almost 23 times. And the equity risk premium is at the lowest we've seen for a long time at 2%, where typically it's 3.5%. So it's very hard to make the case that new money should be going into equities at this point.
Where on the maturity curve would you be emphasizing investments, and would you be going for high quality versus high yield? Would you be going for munis if it isn't a taxable account that you're looking at?
Yeah, we like the shorter to intermediate part of the curve, because you can get actually higher returns than longer bonds, or 80 to 90% of the return of longer bonds in the 2 to 4 year intermediate maturities. We also like higher quality bonds. They are a safe haven. We think that they're a better place to ride out the uncertainties that we're seeing, as opposed to higher yielding credits, where the credit crunch resulting from the banking stresses that we've seen over the past few weeks have not been fully known and have not been fully developed. And so we prefer high grade bonds at this point.
Okay, so Mike, bring it in for us. Lay out your bull case for stocks right here and why we should be feeling confident putting our money where the equities are.
All right, I got a bunch of reasons. I think that we're in the ninth inning, if not the bottom of the ninth, of the Fed increasing interest rates. I feel once that's done, that should ease the strain on the banking system. I also think that, that inflation is going to trend lower and probably exit 2023 in the 4% area. And, I'm not as much of a bear on corporate earnings as a lot of people are. I actually think we're going to find that, corporate America has got very expense conscious right now, and that's going to keep earnings at an elevated level. And as we look out to 2024, I think earnings stand a good chance of growing 10% plus. So you put this good stew together, and I think you have a market that will pivot in September, start looking into 2024, and you have an economy that's growing, you have corporate earnings growth of 10% plus, and you got stock valuations that, they're not bargain basement, but they're not bad right now. So you say you put an 18 multiple on $250 or $260 in corporate earnings, that's how you get to that 4,600 on the S&P 500.